As inflation concerns gradually fade, the risk of economic stagflation is also decreasing. On August 15th, the U.S. released retail sales data that exceeded expectations. The number of initial jobless claims fell to the lowest level since early July, and Walmart's financial report performed strongly. This series of good news eased the previous expectations of economic recession, and the possibility of the Federal Reserve cutting interest rates by 50 basis points in September gradually decreased. The market decline is a thing of the past. U.S. stocks have recovered all the losses since early August. The S&P 500 index is close to a record high. U.S. Treasury yields have risen, the U.S. dollar has strengthened, and oil prices have also risen. Wang Youxin, a senior researcher at the China Banking Research Institute, pointed out that the recent performance of U.S. economic data has been differentiated, leading to differences in market views on the economy. Both the July non-farm payrolls data and the manufacturing PMI were lower than expected, especially the unemployment rate triggered Sam's Law, increasing market concerns about a hard landing of the U.S. economy. However, recently released data have eased these concerns and strengthened the market's confidence in a soft landing of the U.S. economy. Although market sentiment has rebounded, there is still uncertainty in the current rally. Behind the optimistic economic data and corporate earnings reports, some potential risks are emerging. Walmart's financial report showed that its sales and profits exceeded expectations. Despite the continued high inflation rate, consumer spending remained resilient, driving Walmart's performance growth. Retail sales data released on the 15th showed that U.S. retail sales in July increased by 1% month-on-month, higher than expected, which showed strong consumer demand. At the same time, the number of initial unemployment claims decreased, indicating that the labor market remains solid, which further reduces the possibility of a sharp interest rate cut by the Federal Reserve in September. However, there are still concerns about the economic outlook. Despite the increase in retail sales, U.S. industrial production performed weakly, with industrial output falling 0.6% month-on-month in July. In addition, automobile production declined, homebuilder confidence declined, and the manufacturing PMI index also shrank continuously, showing that the U.S. economy still faces multiple challenges. Wang Youxin believes that although recent data has eased market concerns about a recession, the future trend of U.S. economic growth remains unclear, and investors need to pay close attention to the changes in economic data in the future. Although recent economic data has improved, some potential economic headwinds cannot be ignored. For example, U.S. industrial production data performed poorly, falling 0.6% month-on-month in July. Although part of the decline can be attributed to the short-term impact of hurricanes, the overall trend shows weakness. This shows that, in addition to the consumer sector, the performance of other economic sectors remains unstable, especially the weakness of the industrial and manufacturing sectors. U.S. auto production has declined significantly, and homebuilders' confidence is also declining. The Philadelphia Fed's Business Outlook Index fell sharply, and the New York Fed's manufacturing survey showed that the industry has been in a state of contraction for 9 consecutive months. At the same time, inflation in import and export prices was also higher than expected, showing that the headwinds in the global economic environment are intensifying. Wang Youxin pointed out that these unfavorable factors show that the U.S. economy may be heading for a more complex and uncertain downward track. In addition, despite the excellent financial performance of retail giants such as Walmart, the changes in consumer behavior are also reflected behind it. Consumers began to pay more attention to affordability under economic pressure, reducing spending on high-end goods and choosing lower-priced necessities, which also led to the benefits of low-price retailers such as Walmart. Walmart CEO Doug McMillon said that the company's grocery sales have accounted for more than half of total revenue, reflecting the frugal behavior of consumers under inflationary pressure. Although retail data is strong and the number of initial jobless claims has also declined, the sustainability of the overall economy still needs further observation. Wang Youxin believes that the short-term market rebound is more based on the reduction of concerns about economic recession, but whether the market can maintain its upward trend in the future will depend on the performance of economic data in the second half of the year. In particular, the weakness of the manufacturing industry and the decline in consumer confidence may have a negative impact on the economy in the coming months. At the same time, financial markets have also shown a high degree of volatility. Although U.S. stocks have recovered their losses since early August in the short term, investors are still uncertain about future monetary policy. In particular, as the Fed's stance on interest rate cuts gradually becomes milder, the market's expected interest rate cut may be reduced to 25 basis points from the previously expected 50 basis points. This policy shift may limit the market's upside to a certain extent. Analyst Zhang Qi pointed out that although the risk of recession has eased, the rise of U.S. stocks is still fragile. The future market trend will depend on economic data in the next few months, especially key indicators such as consumer spending, employment data, and manufacturing performance. If these data continue to perform strongly, market confidence will be further enhanced, driving the stock market up. But if the data is less than expected, the market may fall into turmoil again. Overall, although the current market conditions are relatively optimistic, investors still need to be cautious. The U.S. economy still faces many challenges, especially the uncertainty of global economic growth, which may bring new fluctuations to the financial market. Investors need to pay close attention to future economic data and adjust their investment strategies in time according to changes in the situation. Looking ahead, the direction of the U.S. and global financial markets is still highly dependent on changes in key economic data and the judgment of the U.S. economic recession. Wang Yoxin pointed out that if the U.S. economic growth rate declines moderately and market sentiment is stable, the Federal Reserve may gradually promote interest rate cuts in a more cautious manner, and the stock market is expected to continue to rise in this scenario. However, if the U.S. economy shows more obvious signs of deterioration, market sentiment will turn pessimistic again, and the Federal Reserve may be forced to increase the rate cut. This monetary policy uncertainty has brought huge challenges to the global financial market. In particular, the increasing differences in monetary policies between the United States and other countries may trigger rapid cross-border capital flows. Wang Yoxin further explained that the carry trade between Japan and the United States will reverse again, and the direction of global capital flows will also change, which poses an additional risk to the stability of the financial market. At the same time, although the inflationary pressure in the United States has eased recently, the decline in inflation does not mean that it has completely disappeared. In particular, fluctuations in energy prices may still bring new inflationary pressures, which will further affect consumers' purchasing power and corporate profitability. With winter approaching, increased energy demand may cause oil prices to continue to climb, thus exerting a new impetus on global inflation. The Fed's policy stance will also continue to be the focus of market attention. Although the market generally expects the Fed to take a moderate interest rate cut, it is still possible that the Fed will adopt a more aggressive policy due to changes in the economic outlook or worsening inflation. This uncertainty increases the volatility of financial markets. At the international level, monetary policies in other major economies around the world are also changing. For example, policy adjustments by the European Central Bank and the Bank of Japan may exacerbate volatility in global currency markets. In particular, after the Bank of Japan's unexpected interest rate hike, global carry trades have undergone large-scale adjustments, which has had a significant impact on U.S. stocks and other financial markets. With the changes in global capital flows, the strong position of the U.S. dollar may be further consolidated. Generally speaking, the U.S. dollar tends to remain strong before the Fed adopts an easing policy. This means that in the short term, U.S. dollar assets may continue to attract investors' attention, while other economies may face greater pressure of capital outflows. Faced with such a complex global economic and financial environment, investors need to maintain a high degree of flexibility. Wang Yoxin suggested that investors should pay close attention to economic data in the coming months and adjust their investment strategies in a timely manner according to the situation. Especially in the stock and bond markets, future volatility may continue to increase, so a balanced asset allocation strategy may be more effective in this uncertain environment. In short, although the risk of a U.S. recession has eased in the short term, the global economy still faces multiple challenges. From inflation to monetary policy uncertainty to capital flow fluctuations, there may be more market adjustments in the coming months. Investors need to remain vigilant, pay attention to changes in economic data, and flexibly respond to possible market risks to maintain a solid return on investment in a complex economic environment. Although the U.S. economy has shown a certain degree of resilience in the short term, the future economic direction still faces many uncertainties, especially in the context of a complex and changing global economic environment. Wang Yoxin pointed out that in addition to the domestic economic challenges in the United States, fluctuations in the international economic situation will also have a profound impact on global financial markets in the coming months. First, rising geopolitical risks may further affect the global economy. For example, tensions in the Middle East, the energy crisis in Europe, and trade frictions between the United States and other countries may have a significant impact on global supply chains and commodity prices. In particular, if these risks escalate suddenly, it may lead to new risk aversion in the market, prompting funds to flow into traditional safe haven assets such as gold and the US dollar, which in turn triggers fluctuations in the stock market and other risky assets. Secondly, as interest rate policies are constantly adjusted around the world, policy coordination among central banks is weakening. For example, the Bank of Japan's unexpected interest rate hike in July broke the long-term loose monetary policy, which not only led to a sharp reversal of carry trades by global investors, but also triggered a chain reaction in global financial markets. Similarly, the tightening policy adopted by the European Central Bank in response to inflation is also affecting the flow of capital markets and increasing the uncertainty of cross-border funds. These factors have exacerbated the instability of global markets. In such an environment, investors need to be more cautious in evaluating their investment strategies. Wang Yoxin suggested that although the market may rebound in the short term, investors should not be too optimistic and still need to remain vigilant about potential risks, especially the market shocks that may be caused by geopolitical factors, global supply chain disruptions, and commodity price fluctuations. In the financial market, some analysts have begun to adjust their portfolios to adapt to the upcoming higher volatility. For example, many large investment institutions are gradually reducing their exposure to the stock market and turning to more conservative asset allocation. At the same time, fixed income assets, especially U.S. bonds, may be favored by more investors in the future, especially against the backdrop of a moderate Fed policy and falling interest rate expectations. From a global perspective, the performance of the U.S. economy has an increasingly significant impact on other major economies. Wang Yoxin believes that in the future, the monetary policy differences between the United States and other economies in the world will become a key factor affecting global capital flows. For example, if the Federal Reserve further slows down the pace of interest rate hikes, the monetary policies of Europe and Japan will be relatively tighter, which may cause funds to flow from other markets to the United States, further pushing up the dollar, and these changes will have a wide range of impacts on global markets. Especially in emerging markets, the strengthening of the US dollar is often accompanied by increased capital outflows, and economic growth in these markets will face greater pressure. At the same time, the global inflation situation remains severe. Especially the fluctuations in energy and food prices have caused greater inflationary pressure on many developing countries, which may force these countries to adopt more aggressive monetary tightening policies, thereby further increasing the fragility of the economy. Wang Yoxin concluded that the global economy and financial markets will be in a highly turbulent state in the coming months. Investors should pay close attention to the further development of U.S. economic data, as well as the dynamic changes in global monetary policy, geopolitical situation, and international trade. In this uncertain environment, flexible response and diversified investment strategies will be the key to coping with market fluctuations. Investors should be prepared for possible market adjustments while also seizing potential investment opportunities to achieve sustainable returns amid a complex economic backdrop.